Pollard is a company. We're very familiar with the company. We've been following it for many years, 5 to 10 years, actually. So one of the reasons why we've been following it is because I just think it's an interesting business. What they do is Pollard is a leading lottery partner for over 60 global lotteries, and what they do is they print lottery tickets, physical tickets, including pull tab tickets, bingo paper. They provide vending machines. They also provide a number of digital services in support of lottery operations, and this would include game apps, iLottery solutions, and others as well. So really, it's a lottery service company, and lottos are generally considered to be a defensive industry. Um, it's not something that is necessarily very economically sensitive. So we like that about the business. We like that it's been a profitable company. Um, just to go through some of the data here, symbol is PBL. It trades on the TSX, Toronto Stock Exchange, trades at a price of about 26.50, 713 million market cap, 27 million shares outstanding. Now, one thing that's really important to note about Pollard is that it was originally founded in 1907, and it is still controlled by the founding family. So 64.2% of the company's shares are controlled by the Pollard family, and the other 35.8 by public shareholders. So this is an interesting thing to talk about, because generally we would say that a high amount of insider ownership, especially by the founder or the founding family, is a good idea because it aligns those owners with the shareholders. Now, in this case, I would actually argue that 64% might actually be too high. And my logic here is just that when the founding family, owns such a commanding percentage of the outstanding shares, it really almost kind of becomes a family business. And I would even question why, unless they have to raise a lot of capital, which Pollard doesn't, why they would even be public. Now, I think that they've done a fairly good job of running the company. There's no complaints that I have there. But you could certainly be in situations where there are decisions that might work well for the family, that don't necessarily work well for the shareholders. So I don't have any issues specifically about their stewardship of the company. It's profitable business. They haven't gone out there and made foolish decisions with the capital structure, which we would not expect them to do, given that they own a lot of the company. One thing, Pollard pays a very small dividend, almost insignificant. So maybe if it were, more focused on the public market shareholders, that would be they'd pay a more meaningful dividend. But I would just say that this is a company that is completely controlled by the founding family, and there are good things about that. There are also risks. But anyways, let's get into the actual company here. Take a look at where the stock has been over the last 12 months. They've had a pretty good run in the market, starting the 12-month period at about $20 and up to $26.50 right now. So good return over the last 12 months. Now, if I were to pull up a 5-year chart, we can see that there's actually been a considerable amount of volatility. Company had a very good run after the pandemic started, actually, like many companies, and then since then has had a big drop in the share price. Recently, the stock price coming back up and showing some signs of strength, but huge amount of volatility, and really the stock not going anywhere meaningfully in terms of annual average return over the last 5 years. But last year has been good for the company, for shareholders, the last 12 months. So let's take a look at the financial results and see if we can identify some reasons why. Now, the Q2 results at face value look very impressive. Sales of 130 million up from 115 million. That's 12% growth. Adjusted EBITDA of 22 million up from about 19 million. So it's 17% growth. And then earnings per share, 27 cents, up from 9 in the same period last year. That's 200% growth. So the first thing that I'm looking at here is, why is adjusted EBITDA growing 17%, whereas earnings per share are growing 200%? Now, adjusted EBITDA is going to represent the operational profitability of the company, whereas earnings per share is going to represent both the operational and financial profitability. So what I mean by that is that earnings per share, this is the very bottom line. So it's not just the profitability from operations, but you're also including financing expenses and income as well. So that's interest expense, interest income in some cases. You're including tax in there. Things that are outside of what we consider to be the operations of the company, but still very impactful to the common shareholders. So really what we want to do here when we see such a discrepancy between the operational profitability and the net profitability is we want to dig a little bit deeper and identify where the gives and takes are during the quarter. So this is going to be a bit of a financial analysis of the company. That's what we're mostly going to focus on in this Your Stock, Our Take segment, but for good reason. So why don't we just start off with I pulled up a snapshot here of the quarterly income statement. So first thing we're going to do, we're going to start off at the very top line. That's the sales. As I said, 130 million up from 115. So, a little bit less than 15 million in additional sales for the quarter. But the problem here is that right when we look here at the gross profit line, 20.14 million compared to 20.89 million last year. So in spite of 15 million in higher revenue, they actually generated less gross profit. So gross profit is essentially the sales less the expenses that are directly related to the sales, or the cost of goods sold, as they're otherwise mentioned, as otherwise referred to. So right away, as we're seeing that what we can get from this is that the increase in sales did not contribute to the increase in profitability, because gross profit was actually lower in the most recent quarter. And we're going to go further down the income statement here. So administration expenses also higher by about 2 million. Selling expenses also higher by about 800,000. So operating expenses were higher. Then we go to the next line here. We see equity investment income, 9.2 million compared to about 5.1 million last year. This is a gain. This is not an expense. This is a gain that gets added to the net income. So there's about a $4.1 to $4.2 million difference here, additional gain on this line, equity investment income. So this is what I would say is the major contributor to the earnings growth over the period. Right, we're going to continue to go down. We see operating income from operations 9.87 compared to 8.72, so about 1.1 million higher. Then we're going to go down to finance costs. So this is essentially interest expense, 2.7 million compared to 4.7. Okay, so they saved about 2 million in interest expense. Then a line lower, finance income. So this is essentially the interest that they're receiving on any cash deposits, 1.7. So that's an additional 1.7 million that we're adding to the net income. And then finally, we'll look at the income taxes here. Total income taxes, 1.28 million compared to 1.52. So in spite of higher income from operations, there is lower income taxes. So what am I getting with all of this? Well, where I'm getting is there is a huge increase in earnings per share, net income. So net income for the period was 7.54 million compared to 2.46 million. So you're looking at about a little more than $5 million difference. 5 million was added to net income. And we need to figure out, well, where did this come from? And where essentially we figured out it came from is the equity investment income, the lower interest expense, the higher interest income, and then the lower income tax. It did not come from the increase in sales. It did not come from the operations of the business, right? So this is very important, because when we're trying to get a sense of what growth is going to be like going forward, we can't rely on higher finance income or necessarily lower income taxes. Like, these are not sustainable drivers of growth. And looking at a line item like equity investment income, well, I don't really know what that is. It's something that's not going through the sales line. So that's something you'd need to look deeper into. What we want to see is that this growth came from the higher sales, ideally stable or higher gross profit margins. And then we basically take it from there. So this is a concern in terms of where this huge growth in net income came from. One thing I will do is I will look at the cash flow statement here. when we look at the equity investment income, one of the things I want to know is this a cash inflow to the company, right? So it's positively impacting net income, but is it actually generating cash? Because that's how you assess earnings quality is, are these net earnings actually translating into cash flow? Well, in this case, it is not. Investment equity income for the 6-month period was 17.8 million. None of that was cash. That was not a cash inflow. That was just an accounting item, right? And the net income for that period was 12.3. So this is a major influencer, this line item, equity investment income, of the profitability. And it was actually higher for the 6-month period than the entire net income. So this is something we have to pay attention to. This makes the financial reporting much more complicated. Now, I will note the cash conversion to earnings actually does still seem to be pretty good. You have 33.8 million in operating cash flow compared to 12 million in earnings. Now, there were non-cash working capital, which will fluctuate from year to year. So, we take that out, and what are we left with? Roughly about, I would say, 17 million in operating cash flow, still higher than the net income reported. Largely due to the depreciation and amortization that gets added back in, because that's a non-cash expense, but there is still a real expense associated with that. But very interested to learn about this equity investment income line item. So we can go to note 6 of the financial statements to figure out what this is. There's 2 entries here in note 6. One is Neo Pollard Interactive LLC. Pollard, in conjunction with Neo Games, operates NPI. The entity was established to provide iLottery services in Canada and also Michigan iLottery. Pollard and Neo Games operate the iLottery operation for the Michigan Lottery under a separate joint venture agreement. So essentially what this is Pollard has a joint venture with another company on assets, and they recognize the earnings from these assets, even though they are not generally a cash inflow to the company. Now, is this necessarily a horrible thing? Not necessarily. I would need to learn more about it, but absolutely we can see in the cash flow statement that it is not a cash inflow from the company. So you have to be very careful about how you treat this line item, because it's adding to earnings. It's making the earnings look good. It's not contributing to the cash flow. So we'll just go on to the balance sheet here. Balance sheet looks okay. I would say still fully leveraged, about 150 million in debt, 260 million in equity. So debt to equity looks fine. But net debt to EBITDA 2.9 times. I don't think that is over leveraged. I also don't think that it's under leveraged. I will just say that it's fully leveraged. And then we'll just look at valuation. So I'm just going to take the full earnings that are on the income statement. I'm not even going to take out those non-cash earnings from the joint venture. That would be about 90 cents in earnings per share over the last 12 months at the current share price of $26.50. That's about 30 times earnings. Certainly not cheap. Given that this is a smaller, thinly traded company with complexities in its financial reporting, I definitely do not believe that 30 times earnings is a cheap multiple. So what is our take on Pollard? I do think it's a unique business. I like where it's positioned. It's been around for a long time. I don't think it's going anywhere. It's in a defensive industry. It does have a history of profitability and a history of revenue growth. However, a lot of this recent growth that we've seen has been generated from non-operational sources. The financial reporting is complex. You'd really need to dig deeper into it. Fully leveraged balance sheet, and I would say a moderately high valuation. So what would we want to see from the company that would encourage us to maybe pick it up as a recommendation? I would say, focusing on that consistent growth in consistent growth from operations. And then also I'd want to be able to buy it at a more attractive valuation.
Yeah, and you looked at the balance sheet, not necessarily completely over levered, but we wouldn't expect a significant juiced up acquisition like at this point,
No.
unless
Just
they issue
imagine
equity,
comparing
right?
that if the balance sheet said, oh, they had, 100 million in cash and no debt.
Yeah,
Then we would be looking at this. It's like, oh, they've got a treasure trove of capital
Yeah.
that they can then go out and they can use to like buy another asset and grow the business that way. So this is why we look at the balance sheet. It's also, I mean, if I were looking at this and it was a net debt to EBITDA 5 times or 6 times, I'd say you don't even consider it because this thing is so leveraged with debt. That
Mm-hmm.
makes it quite high risk. So it's just kind of, it's at that point where, I mean, where would I want to see the leverage? Probably between 2 to 3 times. So maybe average that out to 2.5. It's 2.9. It's not horrible. It's not necessarily great. It's just what I would consider fully leveraged.